Apple is trading at $270.23 right now, showing this incredibly aggressive recovery.
Yeah, it really is a massive bounce.
Right, but with the stock hovering just below all-time highs and, multiple intrinsic value models flashing these bright red sell signals,
Oh, absolutely flashing red.
it makes you wonder, are you looking at a strong buy here, or is this just an overvalued trap waiting to catch retail traders at the absolute top?
That is, well, it's the ultimate trillion-dollar question right now.
Exactly.
Because we are looking at two completely different realities trying to occupy the exact same space. I mean, on one side, you have institutional smart money betting billions on a massive summer rally.
Right.
But then on the other side, when you strip away the emotion and just look at the core mathematical valuations, well, those metrics suggest the stock is just wildly overpriced.
Which means someone is going to be very wrong and someone is going to lose a lot of money. So our mission for this deep dive is to tear into the raw data. We've got the latest financial statements, the technical charts, the options order flow, and, honestly, a rather alarming look at what the actual executives inside Apple are doing with their own shares.
Yeah, that insider data is something else.
Before we jump in, please like the video and subscribe to our YouTube channel. And it is actually compulsory for you to leave a comment with your feedback on this deep dive.
We want to hear what you think.
Definitely. And just to be absolutely clear, before we start pulling this apart, we are simply debating the math and the market data provided in our sources today.
Right. This is purely analytical, not financial advice.
Exactly. So let's get right into the engine room. At $270.23, stock is up 2.59% today. We are sitting in a very precarious historical pocket.
What's fascinating here is the sheer gravity of these numbers. I mean, a company of this size doesn't just float up to a $3 trillion plus valuation on good vibes alone.
Definitely not. Just for context, the 52-week range is $189.81 on the low end and $288.62 on the high end.
Right, so that means we're hovering roughly 6.4% below the all-time high.
Yeah, and to be within striking distance of a 288.10 all-time high, the underlying cash generation has to be historic.
And on paper, it absolutely is historic. If you look at Q1 2026, the revenue hit an astonishing $143.76 billion.
Wow.
Yeah, that's up 16% year over year for just that quarter alone, and net income came in at $44.99 billion.
Okay, let's unpack this for a second, because what I find really telling is the delta between that quarterly growth and the annual growth.
Oh, the 2025 numbers.
Yeah. Zooming out to the full fiscal 2025, annual revenue was $416.16 billion, which is huge, but it was only up 6.4%.
Right.
So if annual growth is 6.4%, but this most recent Q1 just jumped 16%, that implies a massive recent acceleration, right? Like they're actively speeding up.
They absolutely are. And the trailing 12-month earnings per share is sitting right around $7.89 to $7.93.
Which is solid.
It is, but the metric that truly separates them from literally any other hardware manufacturer on Earth is that gross margin. They are holding stubbornly at 47.33%.
That is just insane to me. Maintaining a nearly 50% gross margin when you are dealing with, like, physical supply chains, shipping containers, and rare earth metals.
Yeah, it's unheard of.
Yeah, that is a software margin masquerading in a hardware business.
Precisely. I mean, it means almost half of every single dollar coming in from those massive $143 billion quarters is pure gross profit.
Before operating expenses even touch it.
Exactly. The efficiency of that machine at scale is really the foundational argument for anyone holding the stock right now.
Okay, I see the efficiency, but I also see a crack in the foundation that the bulls seem really eager to ignore.
Oh, the cash flow dip.
Yeah, so Apple holds $29.9 billion in cash and equivalents as of the start of fiscal 2025. And yes, the annual free cash flow for 2025 was a staggering $98.77 billion.
Right.
But that free cash flow actually dropped. It dipped 9.2% in 2025. The data attributes this to higher tax charges and a massive, aggressive spike in research and development spending.
Yeah, the R&D bill's getting steep.
And if a company is burning through its free cash flow at a 9% accelerated rate just to throw money at the AI race, well, that doesn't scream efficiency to me. That screams panic.
You think it's panic.
It feels like waking up to a leaky roof and throwing billions at it just to stop the water damage from competitors who beat you to the AI punch.
Look, I see why the market might reflexively panic over a 9% drop in cash flow. But looking at it as a leaky roof fundamentally misinterprets how architecture at this scale works.
How so?
It's not panic, it's pouring a new concrete foundation. Yes, free cash flow dipped, but $98.77 billion remains one of the absolute highest cash generations in the entire corporate world.
That's true. It is a massive number.
It's a fortress. You don't build the impending AI supercycle without writing massive checks for compute power and talent.
Fair point.
The $29.9 billion cash pile and the ongoing $98 billion annual flow, they're more than enough to insulate them while they build out this new architecture.
Okay, so let's say the R&D spend pays off and the fortress holds. You still have a massive problem, which is the price you're being asked to pay to enter that fortress today.
The valuation debate.
Exactly. The fundamental question isn't whether Apple is a great company. It's whether Apple at $270 is a rational purchase. Right now, the analyst consensus is technically a moderate buy.
Right, with 76 analysts saying buy.
Yeah, 76 buy, 17 on hold, and only 3 saying sell. But the price targets are all over the map.
They really are.
We've got a low of $173, a median of $273.97, and Wedbush is out there targeting a massive $350.
Yeah.
But none of those targets change the reality of the PE ratio.
No, they don't.
We're sitting at a 34.21 price-to-earnings multiple.
Which is incredibly stretched by historical standards. For the vast majority of its history, Apple traded in the teens. Now, the market is demanding a 34x premium.
Exactly, and that premium leaves literally zero margin of safety for retail buyers stepping in today.
Yeah, the math gets tough there.
If you look at the intrinsic valuation models in our sources, they view the stock as overvalued by up to 37%. They put the true fair value closer to $170.
Right.
I mean, I have to ask you, would you buy a stock intrinsically worth $170 for $270?
Yeah.
You weren't investing. You were just hoping a bigger fool comes along to pay $280. Aren't retail buyers just blindly walking into a classic value trap?
Well, if we connect this to the bigger picture and view Apple strictly as a company that sells physical glass and metal rectangles, then yes, 34x is an absurd, dangerous multiple, and $170 is exactly where it belongs.
Right.
But the bull view in the data argues that the fundamental corporate identity has shifted. You aren't just buying a hardware company anymore.
You're buying the services.
Exactly. You are buying an elite, high-margin services ecosystem. That ecosystem revenue alone is now hitting a record $30 billion plus per quarter.
Which is wild.
It is. And high-margin services like the App Store, subscriptions, cloud storage, historically they command much higher multiples than hardware. The bulls argue that this AI-driven ecosystem fully justifies the 34x premium because the recurring revenue is locked in.
I hear that. A multiple expansion based on the ecosystem pivot makes conceptual sense. But conceptually making sense and actually surviving contact with the live market, those are two different things.
Very true.
Let's step away from the balance sheet and look at the actual trading mechanics, because the charts right now are flashing major exhaustion.
The technicals are definitely heating up.
We've got a definitively bullish short to medium trend. They recently flipped prior resistance into strong support at the $262 to $264 zone.
Which is a very healthy technical foundation, by the way. Once you break a ceiling, you want to see buyers step in and treat that old ceiling as the new floor.
And they are definitely defending that floor. It's trading well above both the 50-day simple moving average at $261.83 and the 200-day at $255.65.
So the long-term uptrend is fully intact.
It is. Looking up, initial resistance sits at $278.24, with the final psychological hurdle at $288 to $290. And the MAN CD just confirmed a bullish crossover, sitting at 2.63.
Okay, so a lot of bullish momentum indicators there.
But here's the problem. The RSI, the Relative Strength Index, is sitting at 67.87. We are looking at a fundamental tug of war where the buyers have pulled the rope as far as they physically can.
Yeah.
They are exhausted.
Fast approaching that overbought territory.
Exactly. An RSI of 67.87 is like a car redlining. It's going incredibly fast, but the engine is running dangerously hot. I don't see how this doesn't snap back and trigger a severe short-term cooling-off period before anyone even dreams of breaking $280.
Well, in a vacuum, looking purely at spot market technicals, you are entirely right. An RSI approaching 70 means the buyers are out of breath, and a pullback is standard market mechanics.
Right.
We don't trade in a vacuum. We have to look at the derivatives market, which is acting as a massive structural magnet right now.
Oh, the options flow.
Exactly. The order flow data highlights immense liquidity pouring into July 2026 $325 call options.
Wait, $325?
Yeah.
By July?
Yeah.
That implies massive, aggressive upside expectations.
It does. And more importantly, it changes the mechanics of the stock itself. When institutional smart money buys those $325 calls in huge volume, The market makers who sell those calls have to hedge their own risk.
Right, by buying the actual stock.
Exactly. This creates a feedback loop where the option's liquidity actually drags the stock price upward, forcing it to ignore traditional overbought signals like an RSI of 68. They're putting millions on the line, betting this momentum blows right through the technical exhaustion.
I understand the gamma squeeze mechanics, but, options eventually expire, and that liquidity can vanish overnight.
Sure.
If we are relying on derivative hedging to keep the stock afloat, that feels incredibly fragile, especially when you look at who is actually holding the bag on the other side of this trade.
Sentiment is pretty skewed right now.
Let's look at market sentiment and insider activity, because this is where the narrative gets downright ugly. Right now, a staggering 94.8% of retail CFD traders are long.
Wow, almost 95%.
Basically, every retail trader playing with leverage at home is betting the stock goes up.
That level of retail crowding is a massive contrarian red flag. When 95% of the boat is leaning to one side, there's nobody left to push the price higher.
Exactly. The retail marginal buyer is completely tapped out.
Yeah.
But here's the kicker. While retail is mortgaging their accounts to go long, what are the insiders doing?
Selling.
In Q1 2026, there were 0 significant open market insider purchases. The people who actually know what's happening inside the company aren't buying a single share.
Right.
Meanwhile, in April 2026, CEO Tim Cook, Deirdre O'Brien, and Sabi Khan executed sales totaling millions of shares.
Yeah, that is a tough look.
If 95% of retail traders are on one side of the boat and the CEO is quietly selling millions of shares on the other, isn't that the textbook definition of a retail trap?
This raises an important question about volatility for sure. But we do need to be careful about completely demonizing the executive sales.
Why is that?
Because the data notes, these are largely executed under scheduled 10b5-1 plans. Tim Cook didn't look at the RSI at 68 and decide to hit the sell button yesterday. These sales were legally scheduled months, sometimes years, in advance to avoid insider trading accusations.
Look, I know how 10b5-1 plans work.
Yeah.
But the market doesn't trade on scheduled legalities. It trades on supply, demand, and optics.
Fair point.
Even if the sale was scheduled a year ago, millions of shares of fresh supply are still hitting the open market right now. And it's hitting a market where 95% of retail is already fully invested.
Yeah, the liquidity vacuum is definitely real.
The optics absolutely crush short-term sentiment. Scheduled or not, the C-suite is getting cash out while retail is pouring cash in at the absolute top of the historical valuation.
I won't argue the optics. You are right that the combination of total retail exhaustion and heavy insider supply creates a very rigid short-term ceiling. It's exactly the environment where inexperienced momentum traders get trapped buying the local top.
And if that internal ceiling isn't enough to worry about, we have a massive macroeconomic wrecking ball swinging straight toward their supply chain.
The tariff situation.
Yeah. The sources outline a major bearish risk regarding potential new tariffs on iPhones. Now, we aren't taking any political sides here. We are just looking at the math.
Right. Purely mathematically.
If enacted, these tariffs could effectively double the retail price for consumers. Price elasticity of demand is an unforgiving law of economics. If you take a premium product and artificially double its price, the consumer demand doesn't just dip, it shatters.
It creates a margin versus volume death spiral. If tariffs double the import cost, Apple is faced with an impossible choice.
What are their options?
Well, option A, they absorb the cost to keep the retail price the same. If they do that, that beautiful 47.33% gross margin we discussed earlier collapses overnight. Option B, they pass the cost directly to the consumer. If a base model iPhone suddenly costs $2,000, the sales volume plummets. Either way, whether through destroyed margins or destroyed volume, the earnings per share takes a direct, violent hit.
And if earnings drop, that already stretched 34x PE ratio suddenly looks like a 50x or 60x multiple on the same $270 stock price.
Exactly. The stock would have to reprice violently downward to match the new reality.
That is the ultimate bear case. The combination of tapped-out retail buyers, insider supply, technical exhaustion, and the looming threat of tariffs pulling the rug out from under the EPS.
It's a scary setup for sure.
In that scenario, a harsh correction back toward that $170 intrinsic value model isn't just possible, it's the most logical outcome.
It really is.
But obviously, the stock is holding at $270 for a reason. So let's flip the board. Based on the data, what is the absolute best case recovery and breakout scenario that keeps this engine running?
Well, the breakout scenario is anchored in actual, verifiable consumer resilience. Despite all the macro fears, the data shows that in early 2026, iPhone sales in China surged by 23% year over year.
Wow, 23%. A bounce like that in their most hotly contested, difficult international market is not a fluke. That is a massive signal of brand strength.
It proves the moat is intact. But the real bull case is looking past today and focusing on late 2026 with the rollout of Siri 2.0 and the iPhone 17 AI features.
Ah, the AI supercycle.
Exactly. The expectation is that the hardware has stagnated for just long enough, and the AI features will be compelling enough to trigger the mother of all upgrade cycles. Some analysts in the data are projecting that this AI as a service integration alone could add $75 to $100 per share in long-term value.
Here's where it gets really interesting. I look at their entire AI strategy, and it feels like arriving 3 hours late to a potluck party, but walking in with the absolute best food.
That's a great way to put it.
Right. Competitors rush to market with chatbots and disjointed software. Apple waited. But how does that actually translate to a $100 per share premium mechanically? Like, how does AI as a service justify that kind of valuation jump?
Because of the hardware lock-in, Apple doesn't need to invent the absolute best underlying large language model. They just need to control the toll booth.
Oh, I see.
By integrating Siri 2.0 seamlessly at the operating system level across 2 billion active devices, they instantly become the default AI interface for a quarter of the planet.
That's a massive reach.
It is. They will monetize the compute power, they will take a cut of third-party AI app subscriptions, and they will force users to upgrade to the iPhone 17 just to have enough internal memory to run the system locally. It is a compounding revenue loop.
Which brings us to the ultimate question of timing. We have the long-term AI thesis acting as a magnet,
Right.
and short-term technical exhaustion acting as gravity.
Yeah, quite the collision.
And sitting right in the middle of that collision is the upcoming April 30, 2026 earnings report. If I'm an investor looking at this today, is that incredible 23% bounce in China enough to carry the stock safely through the April 30 volatility?
Yeah.
Or is it safer to just sit entirely on the sidelines and wait for the iPhone 17 clarity later in the year?
Well, if you synthesize the entire stack of data we've walked through today, the reality is that the short term is an absolute minefield.
Yeah, it's rough.
You have the April 30th catalyst, technically stretched charts, tapped out retail crowding, and insider supply. That is a recipe for brutal, unpredictable price swings. Trying to trade the next 10 days is gambling.
Right.
However, if you zoom out, the underlying fundamentals of a 47% margin ecosystem, combined with the impending AI upgrade supercycle, make a very compelling thesis for patient capital. It ultimately comes down to your time horizon.
So we are looking at a company with an undeniable fortress-like balance sheet, printing nearly $100 billion in free cash flow, and a roadmap to monopolize consumer AI with the iPhone 17. But to access that future, you are forced to pay a sky-high 34x valuation today, while navigating a gauntlet of insider selling, extreme retail crowding, and the massive macroeconomic risk of supply chain tariffs.
It's a lot to weigh.
It really is. The tension between the math of today and the promises of tomorrow is stretched to the absolute breaking point.
It is the ultimate balancing act between demanding flawless long-term execution and surviving very real short-term turbulence.
And remember, this discussion was purely an analysis of the provided data, and it does not constitute financial advice.
Always do your own research.
So what does this all mean? I want to leave you with one final thought to mull over as you dig into the charts yourself.
Let's hear it.
If Apple's massive $270 price tag and that historic 34x multiple requires totally flawless, on-time execution of Siri 2.0 and the AI upgrade cycle, just to mathematically justify holding its current just to mathematically justify it, what happens to that multiple and to your portfolio if the AI supercycle is delayed by even a single quarter?
That is the big question.
Thank you for joining us on this deep dive. Keep looking at the data, keep questioning the consensus, and we'll see you next time.